Golden Rule Radio is brought to you by McIlvaney ICA. ICA is America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com.
Welcome back to Golden Rule Radio. This week in the precious metals, you're seeing gold sitting still right around 1800. Silver has actually inched just below $25 this week, but still remains in a rising wedge pattern. And platinum has come down to a relatively strong support level, taking a nice jump up today, about $20. All of this is following on the heels of the U.S. dollar, going back to a discussion we had a couple weeks ago, expecting the dollar to take a turn for the worse, as it has, dropping from around 93 to almost 92 here in the last couple days. So, Tori, where would you like to start today?
I'd actually like to start this week with a couple of listener questions because it does show that people are paying attention, but it also is an indication of questions that a lot of people have that we're hearing on a daily, hourly basis. And Mike Sawyer writes, "This is my favorite channel." Thanks, Mike. Theoretical question, am I helping with the silver squeeze by buying junk? And Miles, I'll let you answer that one, and I'll jump at the next one.
Mike, I mean, it's a fair question. It's a moral question. Am I doing something that benefits me that could be affecting the market as a whole? Am I making the wrong decision? So I'd stick with a much better question. Do you want to own junk silver given what's going on in the market today? And I think you wouldn't be listening to this show if we didn't agree on that answer. So probably not. Generally, squeezes take place in paper markets where you can manipulate with leverage. So the 5 or 10 or 50 or 5 million or whatever number that you're bringing to the table to pick up additional silver is not going to have near as much impact in the physical market where you're just buying ounce for ounce, dollar for dollar as you would if you're going out into a leveraged position. So unlikely. Now, what you are seeing today also, and we've been talking about this for the last year, is there is also a squeeze on physical product. So physical product is outperforming the paper markets, despite some of these concerns we've had, like you mentioned in the silver squeeze. So I would argue no, because you're probably going to see the paper market play catch up with the physical market. And you're going to see the spot price of silver come up to 30 or 32 or 35 to catch up with where even 10-ounce, 100-ounce bars are priced, let alone where things like Canadian Maple Leafs and Silver Eagles are. So no, I do think there are times, and again, I appreciate the question because it shows some conscientiousness about what's going on with the market as a whole. But no, I don't think so. I think that you doing what's best for you and your family needs to take priority.
Yeah, where are your motivations, basically, is what I hear you asking, Mike. And I would say, Mike, if everybody were to do what you're doing, then yes, there would absolutely be an aggressive physical shortage, a squeeze in the silver market. We are already seeing that. We've seen that for about 15 months. And that leads right into the next question. David writes, how do you justify buying physical gold with the high premiums that bring the cost very close to all-time highs that have only been seen maybe 3 times in the entire history, especially for retirement age people in their 60s? Again, really good question. And what Miles has been describing is the premium. So the premium is the price that you would end up paying to acquire an ounce of a product. And that usually is reflected in percentage terms, and premiums are inordinately high right now in the market. Not so much in gold as he asks. With some of the premiums, like in American Eagles, it is getting priced high enough to where it's flirting with the all-time spot price of gold. But there are a lot of ways to overcome those premiums. No, we're not going to put somebody in an aggressively overpriced premium product based on low supply and high demand. So we have to be very smart about what product we end up investing in. For months, we were focusing more in the bullion bars category and avoiding government coins for that exact reason. You're seeing inordinately high premiums. You're even seeing premiums climb in the junk silver that Mike Sawyer talks about. Because junk silver has a finite universe, it's not made anymore. When demand gets high, that supply is restricted. And so you'll see the premium, and that plays right into our premium swap strategy. So that's the other way, David, that we overcome that is premiums are oftentimes our friend. We will sell into a hot premium market and bolster a retirement account rather than buying into a hot premium market and doing undue damage. So great questions. Keep asking. Fire away. And now we're going to dig a little deeper into the charts as we do each week. Miles, start us off with gold.
Sure, although I don't know how much digging I can do specifically into gold. We have a couple other charts I definitely want to take a look at. But anybody who's been watching the gold price over the last week, akin to watching paint dry as gold has moved.
At least we got a little bounce today off the Fed. I mean,
We did.
$10. I'll take 1% every day.
Take your $18. Still, we've been in this like $10, $20 range up or down, like $18.20 to $17.90 for quite a while now. And that's okay. Sideways momentum, gold trying to figure out which direction it's going to go. It is short-term bullish. It is medium-term bearish. And then obviously long-term, it's very bullish, up substantially since it hit bottom at the end of 2015 with the expectation of continued growth. You know, like I always say, the trend continues until proven otherwise, and right now the trend, at least the very short term, last couple weeks in gold, remains sideways. Now, moving over to some of the white metals, getting back to talking about silver, silver actually has been pushing down the last couple days. I think we pointed out on the silver chart, if silver were to turn down, now it has been compressing up and it continues to compress up. We're just at the bottom end of that compression right now. And if it were to continue down, we've got pricing down at around 1915, 1755, even as low as 1470. Those all sound like very low numbers from where we're at now. And all of those numbers are still strong long-term bullish numbers. So think about silver going all the way down to 1470 from where we're at now.
No,
$25.
I'm not going to think about it.
Okay, well, that's $10 lower than we're at now. That's a substantial decline and still bullish.
There you go.
So that tells you how much silver did do between March and July, August of last year. So to have these sideways movements, to have these reversals is very common.
Totally healthy too.
Exactly. And we're seeing it in gold and we're seeing it in silver. Not so much in platinum, which we'll look at here in a second.
Palladium.
Or palladium.
Palladium remains the bully in the room. Now let me ask you a quick question, because you talked about that formation and higher highs and higher lows. Have we hit a lower low yet, or is that trend still intact as well?
Yeah, it's a good question. We're right at it. So if you look at the duration of this silver pattern, this sideways pennant pattern, which started back around July, August, when it peaked out at 30 and then came back down. So it's been 11 months since we have turned sideways and continued to step higher high, higher lows. I'd say we've put in two significant highs, both the first one and then one again right at the beginning of 2021. And we've put in about 4 real lows, really one low in between the two. But each 4 of those have been higher. Now, we are right at the previous lowest low, but we would have to really push down to the low that exists between the two highs I'm showing on the chart here now. You can see the two highs. There's a couple lows in there, but there's one that exceeded the other. So we would have to push between the low that took place around November of last year, which is all the way down at around $23. So we would need to see silver break not just out of this rising compression, but break all the way down to really show us a downward trajectory and pushing below that low point from the end of last year, down around $23. There's really nothing bearish about silver. Even though silver has come down since around the beginning of July from $26, $27 down to below $25, the movement up, getting back to what we were talking about at the beginning, going from $12 to $30 in 3 months. So the idea of having some type of retracement back could be significant and not break any type of trend.
I'll say, too, that during this period of time that silver has trickled down, if you will, the ratio has climbed to 73 to 1 in terms of gold to silver. So you've gotten a better value in silver nominally and in relative value compared to gold. So with ratio trading strategies, you've just gotten about a 12% better gold price in the future by having climbed from the 62. So stay the course, buy the dips on the silver, give us a call and we can help you acquire and again avoid premiums in an IRA or otherwise. So we also mentioned that we did hear from Chairman Powell, right? Jerome Powell spoke today. The Federal Reserve gave us a little pop in gold and knocked down the dollar just a little bit, because they are going to continue to purchase government bonds and mortgage-backed securities to the tune of $120 billion a month, because the central bank decided not only continue to do that, but not raise interest rates. So they're not even going to adjust the pace at which they're buying those bonds each month. Investors are paying really close attention because you've got this Delta variant of COVID-19 coming out, impacting the economy. We know that employment's not all that healthy, but the fact that they're continuing to buy mortgage-backed securities is a big question because the housing market is hot as can be. The lending principles are completely different than they were in the setup to the financial crisis and housing crisis 2005 to 2008. So what are they doing? Why are they doing it? When do they start tapering? And until they do, and they continue to add to the balance sheet, again, that's just creating money, creating money. Then they also say that they're a good deal away from making substantial further progress, quote, substantial further progress, unquote, towards the Fed's dual mandates of stable prices and maximum employment. Yeah, you think you're a good deal away? You're a really good deal away. And it's a bad deal for the rest of us because you are so far away from seeing stable prices and so far away from maximum employment. Tell every fast food and service industry and any restaurant in general how healthy you think the employment market is. We've talked about this on this show. So anyway, he says they've got a lot of ground to cover, or some ground to cover on the labor market side. That's an understatement. So keep your eyes on what they do, not on necessarily what they say. Not a whole lot else to report, Miles. Politically, geopolitically, not a lot of strains pushing gold. Oil's kind of sitting there. And we're still waiting on this infrastructure spending discussion and vote coming out of the halls of Congress. And that will also give us a jump in the gold price when it gets passed.
So that's going to do it this week on Golden Rule Radio. As always, we appreciate you stopping by. Keep the comments, questions, concerns coming. If you liked what you heard, you can hit the subscribe button or ring the bell, whatever those things do on YouTube. You can find us on Twitter at ICA Gold, Facebook, McIlvaney Financial, or our website, McIlvaney.com. And as Tori mentioned at the beginning of the show, if you'd like to discuss precious metal strategies within your personal portfolio, we always encourage you to give one of the advisors here at ICA a call at 1-800-525-9556.
Thanks for listening. Have a great week.